Short selling in the stock market. Short selling is an investment strategy where an investor borrows a security, sells it on the open market, and then buys it back later at a lower price to return to the lender. This strategy is based on the expectation that the security's price will decline. It can also be used as a risk management tool for investors who believe the market is headed downward. There are two primary types of short selling: intraday short selling. Definition. In this type of short selling, an investor borrows a security and sells it on the same trading day, buying it back before the market closes to return it to the lender. Reasons: to profit from intraday price fluctuations, to capitalize on a short-term bearish market outlook, to take advantage of perceived overvaluations in a stock. Risks: rapidly escalating losses if the market moves unexpectedly higher. Liquidity risk, especially for thinly traded securities where it may be difficult to cover the position. Longer-term short selling. Definition. In this type of short selling, an investor borrows a security and sells it, holding the position for a longer period before buying it back to cover the short. Reasons: to profit from a long-term bearish outlook based on fundamental analysis, to capitalize on a broader industry downturn, to express concerns about a company's management or financial health. Risks: greater sensitivity to unexpected market changes due to the longer investment horizon. Interest costs associated with borrowing the security, which can erode profitability over time. General risks of short selling. Unlimited loss potential. If the market moves significantly higher than expected, losses can be unlimited. Liquidity risk. It may be difficult to close a short position quickly, especially for thinly traded securities. Leverage. Short selling can magnify both gains and losses, increasing risk. Regulatory risks. Short selling is subject to regulations by the Securities and Exchange Commission, SEC, and changes in these regulations or violations can lead to legal consequences. Conclusion. While short selling can be a profitable strategy for experienced investors, it carries significant risks. Before engaging in short selling, it is essential to conduct thorough market analysis and carefully consider the potential risks. Additional notes: short interest. The total number of shares that have been sold short. Short squeeze. A rapid increase in a security's price caused by short sellers buying back shares to cover their positions. Uptick rule. A regulation that restricts short selling when a stock's price is declining. Warning: investing in the stock market is risky. Be sure to do your own research and consult with a financial advisor before investing. This information is not intended as investment advice. The author and publisher are not responsible for any losses incurred.